everybody for transitioning over from the coffee break and settling down. So for our next session of papers, we're going to be springboarding away from the topic of the bank lending channel and focusing on monetary policy challenges, associated with different issues, some of which are related to dollarization. But we'll start our first paper in this session with a piece that will emphasize issues related to monetary policy frameworks, as well as issues pertaining to central bank transparency and independence. So our first speaker in this session is Dr. Brandao Marques, who is currently Deputy Chief in the Advanced Economies Unit at the IMF, at the IMF's European Department, focusing on the Euro area and macro financial issues. Luis is also Mission Chief for Latvia. He was previously an Assistant Professor of International Economics at Johns Hopkins SAIS and worked in corporate banking in Portugal. His research interests include the distributional effects of monetary policy, financial stability, and the impact of state aid on firms and their competitiveness in Europe. So without further ado, let's give our speaker a welcoming hand. Luis, the floor is yours.
Thank you. Thank you so much. So thank you so much for this really nice introduction, and also for the opportunity to be here among very distinguished speakers and to talk to this very engaged audience about a really relevant issue for emerging and developing economies, which is how to conduct monetary policy and what are the challenges. So this presentation is based on joint work with Gaston Gelos, Thomas Harries, and Ratna Sahai, who at the time were all at the IMF with me. Since then, Gaston has moved to the BIS, and Ratna has retired from the fund. And also, in addition to these three names, another co-author is Yi Shui, who is now at the Bank of America Merrill Lynch and used to be at the IMF. Very important disclaimer. So if I say something that is nonsense, it's entirely my fault. So these are my views and not those of the IMF or its executive board or management. So it's important disclaimer. So I'll just briefly go over, the outline of this short talk. So I'll start by introducing and motivating the work, right? So why is it important to discuss monetary policy transmission in emerging market and developing economies? And then this will be followed by a short methodological section where I'll talk about the data, the variables that we use, and also the empirical strategy. So here I'll explain basically, what is our identification strategy and how do we measure transmission. And then after that, I'll present, the main results of the paper. I'll briefly discuss a little bit of robustness analysis, but for this presentation, I kind of skipped most of that. If you're interested, you can find it in the paper that is still posted as an IMF working paper. And then I'll conclude, with some takeaways and also what this means for policy, right? So, so what is then the questions that I'm trying to address here, right? So the first question is, this is, I think, is bit motivated by a lot of the discussions we have with country authorities that reach out to the IMF looking for help, that we provide as technical assistance, for example, part of the fund's capacity development pillar, or as policy advice, as part of our both surveillance and program lending. one of the perennial questions is, what can we do with monetary policy if there's no transmission, right? So we change the interest rates, or we change the growth in money aggregates, and nothing happens. Inflation doesn't come down, right? Output doesn't respond. This is kind of hopeless, right? So there's a first factual question here is to ask, is there really no transmission in emerging markets through interest rates, right? So we're really interested in an interest rate-based monetary policy, right? Of course, it's important to recognize that there are other ways of conducting monetary policy. This is especially true for developing economies, right? Where the framework is not really around steering the interest rate to affect monetary and financial conditions, and therefore affect ultimately prices and output, right? And it's more geared towards, for example, working with reserve requirements, right? Or with other types of interventions that change money aggregates, right? And we try to kind of address that issue in the robustness section, because even in our sample, there are some countries that it's unclear where they really use the interest rate as their main tool, right? And second, once we establish that, this kind of a preview of the results, once we establish that there is indeed some transmission, right? What does it depend on, right? So what are the country characteristics that can make transmission weaker or stronger, right? And in particular, we were interested in this question: is it more financial development, or is it more the quality of the monetary policy frameworks? Again, this is motivated from interactions with central bankers and policymakers. That when the fund and others, including I'm sure Ken, say, well, you really need to improve your frameworks, or you need to conduct a monetary policy that is more interest rate based. Often an objection that we hear is, well, but the level of financial development in our country is so low that that's kind of hopeless. I need to develop financial markets first, right? Bond markets, Shevin alluded to that yesterday, the importance of the early bond markets, before I can actually have, a modern monetary policy framework, right? So we try to address that question: what matters more, right? Is it the financial development, or is it the monetary policy frameworks, right? So this question, in a sense, has already been answered before for advanced economies, right? So there's a very interesting chapter of a handbook by Boyven, Kali, and Mishkin in 2011. It looks at transmission of monetary policy and asks this exact same question: is it frameworks, is it financial development? But they only do it for advanced economies, right? Where, if you really think about it, this question is, I think, more relevant and more interesting for emerging markets and developing economies, right? Because that's really when you have this trade-off, what shall I do first, right? So this is, not just important as a research question, but it's also very important as a policy issue, right? So that we can overcome a certain reluctance to move toward a more interest rate based monetary policy. So we will then look at these issues, following a important literature that has looked at this issue of, what is the transmission of interest rate changes to output and prices, right? So we are not concerned here with the transmission of policy rates to interbank rates or lending rates. That's an important aspect, but we're kind of bypassing that. And we're looking at what is the transmission from a policy change to output and inflation, right? Most of the studies, that have been done so far focus really on that transmission from policy rates to short-term rates, and then to long-term and lending rates, right? And what this literature finds, right, is, well, there are maybe two broad explanations, right, for why there isn't a lot of transmission to interest rates, right? And one is, well, there's really something different about emerging markets and developing economies that hinders this transmission, right? And so that will, what do you call, the facts on the ground, right? So that would mean, well, you don't really have an independent central bank, right? So there's no transmission because the market doesn't know how to read the policy changes, right? Well, there's an issue of fiscal dominance. There was something that Santiago alluded to, right? To the crowding out effects, of bond holdings, right? And so that fiscal dominance also hinders the central bank's ability to steer monetary and financial conditions because it's really not trying to achieve price stability or macroeconomic stabilization. Is trying to fill other goals, including financing government deficits, right? Then I think this also pertains a lot to Camille's work, right? The issue of contracting, the environmental, the legal work, the legal environment is very weak, so contracts can't really be enforced. Santiago also alluded to that. It's very difficult to recover collateral, so there's not a lot of lending going on. So it doesn't really matter that you change the policy rate if there's no credit channel going on, right? Also, there's no transmission to interest rates because the interbank markets are very underdeveloped. I remember that someone mentioned yesterday the issue of remittances. There was a question about remittances. This is a perennial problem in a lot of these developing economies, that the banking systems are flooded with liquidity, right? And so you can try to steer your policy rate, but the interbank rate is floored at zero because nobody needs liquidity, right? And so that means that there's not a lot of transmission there, right? And finally, one thing that is very important for this work is, because there's really not a lot of exchange rate flexibility, right? And this is something that we point at, right? The exchange rate channel, when these other channels are impaired, the exchange rate channel is like really key for transmission, right? A second explanation is, well, we don't find transmission, right? Because the data are horrible, because the empirical strategies are not appropriate, and all that is true, right? So we try to deal with these two kind of explanations of why you don't find, or why it's difficult to find transmission. And so for this effect, in particular, to address the problem of the quality of data, the coverage, the country coverage, we use a sample of 40 emerging market and developing economies. So, of course, there's an overrepresentation of the larger emerging market economies for obvious reasons. But we try to overcome that by being kind of a little bit creative in how we measure, for example, economic activity. So we do this at the monthly frequency. So we use indices of industrial production or economic activity where they exist. But in some cases, we have to use like electricity consumption, for example, as a proxy for economic activity, right? And then we also use the consumer price index, which is more widely available than measures of economic activity at the monthly frequency. Then in terms of the key explanatory variables, we use short-term interest rates, right? So these are overnight interbank market rates whenever the policy rate doesn't show a lot of variability, right? And if you work in this area, you know that often the policy rates don't move a lot. They're not very meaningful, right? So in that case, you really have to look at overnight interbank market rates, right? Of course, Shebna warned us yesterday about this problem of using short-term rates. I mean, I think in her paper she's using treasury bills. So these are 3-month rates, right? Ours are much higher frequencies. So I think part of this issue of term premium and risk premium may be a little bit less important, but it's still there, right? So we recognize that there's a measurement error problem there, but you have to work with the data that you have, right? So, and then we use a series of controls, right? We have the nominal effective exchange rate or bilateral exchange rate whenever that one is not available. We include, a set of global controls. Some have already mentioned here, like the VIX, U.S. policy rates and so forth. And then because some of these countries don't have, actually, we still have a lot of agricultural production. We control also for weather conditions, right? So kind of we're trying to capture like these supply shocks, right, that could be hitting the economy. And for that, we use a bit in line with what Camille was using about the satellite data. We use NASA satellite data that creates these measures of precipitation and temperature anomalies. I thought it was incredibly cool. It was a lot of work. It didn't make any difference in the results, but I think it was cool to do that. All right. So we also use data on economic forecasts. You'll see that in the identification part why that's important. And then we have a series of institutional variables that we're going to use for control and interact for country characteristics. So we use indices of financial development. The key one is this index produced by Ratner and co-authors in a fund paper 2015, which is actually updated frequently. But we have other measures like right to GDP, measures of financial inclusion, like the number of ATMs per 1,000 inhabitants, so and all that. We have like a new, at the time that we wrote this, measure of dollarization. This uses the percentage of foreign currency deposits and foreign currency loans. This is from a restricted IMF data, right? So you don't have this data available for many countries publicly. And then we have variables for the quality of monetary policy frameworks, whether they, for example, have a inflation targeting regime or not, right? Whether they use more interest rate policies or not. So this is the main source is the IMF's maintained AREA database, right, for exchange rate restrictions and arrangements. Measures of economic independence, we have that index by Carolina Garriga, Dinserak and Greenstone Bank Transparency, and then we use a series of measures of institutional quality at the country level as controls, because sometimes the quality of the monetary policy frameworks is really correlated with the overall governance of the country, right? All right, so the sample starts in 2003 for most countries. I have to say it starts in 2003 because of Turkey, because if we started earlier, we had like a huge episode in Turkey and just kind of like everything went crazy. So we started in 2003, but we have monthly data, so there's quite a long time series. We don't have to worry about, in the panel setting of, working with fixed effects and so forth, right? So the method, we use a panel local projection. I apologize that country by country is a typo, that we use a country by country identification of the policy shock. And the reason why you use the local projections and the panel setting is really because it helps us doing these interactions, right? So if you're really interested in doing interactions, this is like the easiest way to do this, given that we're working with country level data, right? But of course, like a VAR, it also requires identification assumptions, and we do that in 2 steps. So the first step is we estimate the monetary policy shocks. Now, of course, there are much better ways of doing this, right? The problem is there's much better ways of doing this, right? When you get to emerging markets and developing economies, they really face a wall, right? It's like, you don't really have, very good forecasts, right? Or, you don't have high frequency data for interest rates or market prices. So you can't do that type of high frequency identification. We do try to do that for a subset of countries later on. But this is like the main thing. So what do? We estimate basically a Taylor rule where we control for output forecast, inflation forecast and a bunch of lags. And we use the residual as our shock, right? So, we can almost think of this, like the right analogy would be like, this is almost like inverse probability weighting, right? Because you're basically saying, well, our observation of the policy shock is not systematic because it cannot be explained by observable. So it has to be something almost a random assignment, right? I know it's stretching the econometrics, but that would be like the nice way of saying it, right? Now, there are some countries here that actually have currency pegs, right? So they have currency boards. And for those countries, we use the interest rate of the currency to which they are pegged, right? But they're not many, it's just Bulgaria and Ecuador, right? And we do some robustness where we take them out, doesn't make a difference. All right. And then we plug in this residual, right, into the local projections equation. This is a typical local projections equation, done in logs for output and inflation. If you are familiar with this, the impulse response would be the estimate of the gamma naught coefficient that is associated with the residual. And then we'll do an innovation here, which we want to explicitly account for the exchange rate channel, right? So we interact that shock with the exchange rate move that happens at the same time. So the idea is that, there's kind of a signs restriction assumption here, right? That you think, well, if there's a policy change, the exchange rate will move after the policy change. or simultaneous, but it's driven by the policy change, right? And we're looking at movements in the exchange rate that go in the supposedly right direction, right? So if you hike the rates, the exchange rate appreciates, right? And so we look at the local projections, like the impulse responses when that happens versus when the exchange rate doesn't move. So that's how we do it, right? So I'm gonna. So we present two sets of results, right? So gamma naught is the impulse response function when we shut down the exchange rate channel, and then the total effect, right? So will be gamma naught plus the coefficient associated with the interaction of the exchange rate with the policy change times the volatility of the standard deviation of the exchange rate movement, right? That's the total effect when the exchange rate channel is working. So that will be a different impulse response. So these are the benchmark results, right? So on the left-hand side, you have the output response. Whenever the blue line is whenever there's no exchange rate movement, and the red line when there is one. And you see that in both cases, there's transmission, they're not different from each other. Where things get really interested is in inflation, right? So when you do have the exchange rate moving, there's basically no price puzzle, right? So the CPI goes down with a tightening, but when you have a fixed exchange rate, then nothing happens to inflation, right? Actually, it goes up as usually, as we see in many cases in the advanced economies literature where you have this price puzzle, right? So the way we take this, okay, so it's important to account for this exchange rate channel, right? There are probably better ways of doing that, we're definitely using a proper general equilibrium model is a better way to do that, but really trying to present stylized facts here, right? Now, given that, looking at the examples where we have exchange rate movements, right? What matters in terms of country characteristics to change the strength of transmission, right? So we do these interactions. The first ones is, I'm going to just present here the ones with an inflation targeting dummy, which I call IT. So we collect the data whether countries say that they have an inflation targeting regime or not. Again, measurement error, because sometimes they say they do, but it's, Uganda has an inflation targeting light, right? But, there are many countries that say they have inflation targeting and it's not even light, right? So let's put it that way. So there is some measurement error, and there's also a problem with endogeneity, right? So the adoption of inflation target is also endogenous to the transmission, right? And we address that in a robustness section. We'll not discuss that, but we endogenize also that choice, right? And then you have the other interaction is an index of financial development. So that's the Sahai and the other index. And we estimate the impulse response functions with these interactions. So it becomes a very, very complicated local projection equation, lots of interactions. And then we just plot the impulse response functions by percentile of this interacting variable, right? So when you have, in the case of IT, it's either 0 or 1. So there's no inflation targeting, there is inflation targeting. In the case of financial development, is low financial development, high financial development, right? And so these are the results for financial development. So the red line is when financial development is high, the blue line is when it's low, the dotted lines are the 90% confidence intervals, right? And those squares that you see on the red line, they tell us whether there's a statistically significant difference in the interaction with financial development, right? So say that the two solid lines are statistically different from each other, right? And what you see is that when financial development is high, yes, there is stronger transmission to outputs, but when you look at inflation, it's actually the other way, right? So not very intuitive, the result. So in the end, yeah, it probably matters, right? But it's not clear why it matters. And we get like very consistent results, regardless of the measure that we use, right, for financial development. So it's not very clear that it matters all that much, but, but we can't say it doesn't, right? And then when we look at inflation targeting, then clearly, for output, there's a much stronger response, right? In fact, when you don't have inflation targeting, there is no response, right? The output doesn't respond at all. And with prices, you have the same picture, although, the two lines are not statistically different because, there's a lot of noise in the data and the identification may not be the best. But I think the key takeaway is that there's actually a statistically significant response under inflation targeting of inflation, goes in the right direction. So clearly, inflation targeting strengthens transmission to output and prices, right? And this is not just, spurious, right? It's not just because, oh, you are inflation target, but, you also have better contracting, right? You have a more efficient government. You have an overall better quality of institutions. We do like even more interactions, right? And what we find is that when you compare countries with the same level, I'm sorry, that was the next one. When you compare countries with the same level of government effectiveness, depending on whether they have inflation targeting or not, you see that there's a difference, right? So countries with low government effectiveness, but IT, they have stronger transmission. Countries with high government effectiveness, but IT, they also have stronger transmission than the ones that have low government effectiveness. So we settled that, right? And then we do like this race, right? We put the financial development and IT together. And so, okay, now we want to see, right? Does it make, which one makes the most difference, right? And what we see is that, what the green and red lines are showing is that whenever you have inflation targeting, regardless of your level of financial development, you have stronger transmission to output and prices, right? And it's very clear for output. So that, for us, we take that as saying, well, if you want to choose, given that they both matter, but if you want to pick a side, it seems that frameworks matter more, right? So this is important for policy, right? Because when we're facing with this dilemma, so how can I improve my monetary policy frameworks if I have no financial markets, right? I think the right way to think about it is, so you can start, right, and then markets will develop, right? Because the quality of these frameworks is important for financial market development. Right? And so that shouldn't stop you, right? You should start getting going, improve the framework, create an independent central bank, right? Create a monetary operations framework, create a modeling apparatus in your central bank so that you can have better decision-making and also better communication, right? Now, we also did this at countries that only have a completely well-defined interest rate-based policy. This is also data from the year, right? Just thinking about, well, could this thing, our results really be driven, right, by the fact that we're using countries that really don't use the interest rate, right, although they say, right, and they're using other things. And what we find, is broadly similar, right? There's, with high financial development, a stronger transition to output, but that's not true for prices. And whereas for IT, we get the opposite conclusion, although here, the results are weaker because we have 5 minutes, right? Because we have a much smaller sample, right? So we already covered this. Then, I think the one that, the conference organizers were really interested in, I have one slide on that, which is dollarization, right? So when you look at the responses by dollarization, right? So it doesn't really seem to matter all that much, like from a statistical point of view, right? So there's not really a big difference in transmission. Now, of course, if you look at the point estimates, they still tell you that if you have high dollarization, you're going to have a somewhat weaker transmission, right? But there is still some transmission, right? So dollarization doesn't completely shut down transmission. And here the key thing is, right? Remember, we're doing this assuming that the exchange rate is moving in the right direction. So you're allowing the exchange rate to float, right? Now, if you don't allow that, in fact, there is no transmission, right? So the key thing is that you don't have fear of floating. Now, that's easier said than done, right? But there are ways, to gradually allow for more exchange rate flexibility, which will then also help with de-dollarization. So conclusion, and then I'd like just to spend a little bit of time, talking about policy implications, right? We found that, there is transmission, right? Based on an interest rate-based policy to output and prices. Key here is this exchange rate channel, right? You need to allow for exchange rate flexibility. In terms of policy, adopting a modern monetary policy framework, something like inflation targeting or an interest rate policy enhances transmission. It's likely more important than financial development. Financial development also matters. And even in dollarized economies, there is some transmission, right? So to use my last 3 minutes, I shut it down, right? So that people are not really distracted. 3 minutes, okay. So 4 minutes, okay. So what do we do with these findings in terms of policy, right? So should we just not bother with financial development, right? And just spend all our energies in developing the framework? And I think, the qualified answer is no, right? Of course, financial development still matters, right? And there are many important things that the central bank can do to develop its financial markets, and particularly its debt markets, and it can help that, for example, by setting up a modern operational framework for monetary policy, right? So this, of course, requires that you have a good apparatus to forecast the liquidity for central bank, the liquidity for bank, the demand for liquidity by banks, by commercial banks. So having a good liquidity forecasting apparatus. But it also requires you to be able to mop up the excess liquidity that you have in many jurisdictions, right? So, again, the example of the remittances, right? When you have a lot of remittances and banks are flush with cash, you need to mop up that liquidity so that the interbank rate actually moves when you move the policy, right? And is not always floored at a much lower level, right? Of course, the problem with that, is that's expensive for the central bank, right? Because, you either issue your own notes, right? And you pay interest on those central bank notes, or you could use it, with government bills. And of course, then you're going to be subject to interest rate losses associated with those bills. So that is of course, something that central banks must do. Doing that will also, for example, foster the creation of a short-term market for debt, or a market for short-term debts, right? But, from a framework point of view, right, the central bank will be able to mop up this excess liquidity and to have this sound operational framework if it really is an independent central bank, right? So if it's not worried about incurring losses, right, and then having interference with its mandate because the central bank has now a negative net equity, right? So this is something also that before my talk, we were talking. Ken was saying that the fund hasn't done a lot of work on dollarization recently, which is to some level true. But there was also this very old work about central bank balance sheets. Does it matter that the balance sheet is incurring losses, right? And I think that work we have new things coming out at the IMF that are very relevant, right? So it's important to have a legal framework that shields the central bank from these issues, right? So again, we get back to these frameworks, right? It's also important that, although recognizing that the central bank has a very important role in fostering financial market development, especially fostering payment systems, right, which is key, right? It's important that this role is kind of separated from the monetary policy function, right? So this, Shevlin alluded to this yesterday when, we don't want central banks having multiple conflicting goals, right? So one way is that you really have, in the governance of the central bank, you separate these functions, right? And you have a financial stability function with a financial policy committee that is separate than the monetary policy committee that deals with the monetary policy. And you have the markets function that is dealing with development. It's really not subject to or subordinating the monetary policy function, right? So it's really important then, to adopt this inflation targeting type framework where the central bank is using an interest rate based policy and is really focused on price stability or macroeconomic stability, rather than in a multiplicity of goals that could be conflicting, right? All right, 1 minute. So yep. I'll finish on time. So the other thing is, I think, is key, right, in terms of policy is like recognizing that financial development is endogenous to policy, right? It's endogenous to monetary policy and to the quality of the frameworks, right? So you're much more likely to be able to develop your financial markets and your financial sector if you have an independent central bank, if you have a transparent central bank, if you have an effective communication that steers expectations, and if you have a willingness and an ability to act, right? So there's a kind of a line that we often use when we're discussing central bank communications. It's not enough to talk the talk, you have to walk the walk, right? So, just trying to steer expectations to communication is like not going to work if you're not willing to hike interest rates when it's painful, right? So it's important to be able to do that, and so therefore independence is important, right? And finally, it's important to know when to do that, right? So you need to have a modeling and forecasting apparatus in place. And this is, of course, demanding. The fund helps a lot with technical assistance. I'm sure that some of you may have already benefited from that, but it's important to have that to support decisions and communication, right? So in terms of dollarization, and again, I'm leaving this to the very end, and what can monetary policies do monetary policy frameworks do for dollarization? Well, definitely one of the reasons for dollarization in the economy is the lack of credibility of the framework, right? So if monetary policy is not credible, then of course you have currency substitution, right? So making monetary policy more credible over time, right, will also help with the dollarization, right? Now, there are other things that central banks have done and with some degree of success, and these are not really about monetary policy, but more about using prudential requirements. For example, you can have differentiated reserve requirements for dollar-denominated deposits versus local currency deposits, right? That create a wedge between the two types of deposits. Or you can have more demanding macroprudential policy requirements like LCR, liquidity requirements for dollar liquidity than for local currency liquidity. So once you create that wedge, very gradually, provided that you're still working on improving your framework, right, you're more likely to see a de-dollarization. All right. In time? Okay, great.
Thank you. Thank you, Luis, for that very insightful journey into emphasizing monetary policy frameworks, particularly when the bank lending channel is expected to be weak.
Yeah.
Okay, so we have about 10 minutes for questions.
Morning. Thank you for the presentation. I am Tanya from Zimbabwe. I have a question. In your presentation, you said it is the monetary policy framework which matters compared to governance issues, even if countries are suffering from governance issues. But how possible it is to have an effective monetary policy framework and a credible monetary policy framework, given that most developing economies, they are suffering from state legitimate issues with regards to governance issues. And I understand that governance issues, they fit into the quality of institutions. So how possible is it to implement a monetary policy framework which is workable? Thank you.
Okay, I can, right. So that's paraphrasing Santiago. That's a very difficult question. Right. So, of course, the improving monetary policy frameworks, right, is usually easier if it's done in the context of multiple reforms that improve the overall governance, right? So to improve the overall country governance. So, I think one thing which could be interesting, I haven't really done that, but maybe some of you can do it, is, for example, look at the impact of IMF programs that often come with conditionality. That both mandate, for example, in the case of monetary policy, that you have an independent central bank, or you upgrade your monetary policy framework with very specific recommendations, but often also have other types of conditionality associated with the governance, in the fiscal sector, for example, and so forth. And looking at whether those actually make a difference, right? And my guess is that they do make a difference, right? If you include the reform of the monetary policy framework in a broader package of reforms, it's more likely to work.
Good morning, Professor. I'm Manzoor Morshed from Bangladesh. I have two questions. I have seen the slide about dollarization. I'm curious, if any country adopts dollarization, then there will be less monetary policy challenges. So if that is the case, why a country should not adopt dollarization? Second thing is, I have seen that many countries have adopted dollarization, especially Zimbabwe. Then they introduce a new currency, but still they cannot maintain the price stability or inflation. What if a country adopt digital currency system backed by dollarization or dollar within the local economy? In that case, do you think this kind of mechanism will control the price stability or inflation? Thank you.
All right. So all easy questions. Right. So we get back to this debate of whether you should have a fixed exchange rate system, right, or namely a currency board, or dollarize your economy completely, like Ecuador, right, or even before that Panama. in that case, you effectively do not have monetary policy, right? Unless you have some capital controls that can create a wedge between domestic interest rates, right, and the dollar rates, right? And there are some examples of that, right? Of especially certain currency areas that are pegged to a hard currency, but they still retain a little bit of monetary sovereignty because of capital controls. But in the absence of capital controls, you'll be effectively surrendering, your monetary policy, and you'll be asking another central bank to do it for you, right? That, of course, if a key issue is to garner credibility, right? That's a way to do it, right? But of course, it comes with other problems, right? You're not as able to address asymmetric shocks that affect your economy, but not the economy of the anchor currency country, right? As to using stable coins, and I have to admit that that's really outside of my expertise, so I'm not going to comment on that because my opinion is as good as the next person walking outside this room. So I don't feel that I'm able to answer that.
I'm Betuel from Mozambique. I have one question regarding the communication and credibility of the monetary policy. And the question is how to deal with the communication of the monetary policy in the context that the central bank cares about the core inflation while the whole society is worried with the headline inflation. How to deal with this situation in the context of communication of monetary policy. Thank you.
Yeah, that's a very good question. Right, so central banks care about core inflation because, especially in an open economy, right, that captures more the domestic component of inflation, which is what you should be really trying to focus your attention on, because there's not a lot you can do about inflation that is driven by these volatile components, right, like food prices and energy prices, right? So you want to see through these shocks, provided that they're not feeding into inflation expectations. So I think, central banks, they really assign a lot of weight to core inflation, but they also have to keep an eye on headline inflation to be sure that, that these changes in inflation will become entrenched in inflation expectations. I think in terms of communication, perhaps like the key thing is you have to be focused on, or at least use your forecast, right, of inflation as the anchor for your communication, right? And then once you're doing that, then the fluctuations in headline versus core, they really don't matter all that much, because over time of the policy horizon, they kind of go to zero, right? So if you're kind of keeping that, that more like 2-year ahead focus or 1-year ahead focus, and using your central bank forecast as a way of anchoring your communication, you can overcome that problem, I think, or at least you mitigate it. Yeah, so that would be kind of like my recommendation. So using, for example, a monetary policy report, right, that is done like quarterly, right, where you publish a forecast, right? Of course, you will take time to build that, right, because that's not exactly something easy to do. But using that as a way of explaining in more words your reaction function to the market, right, and to agents. But then using like this regular press conference to really be pedagogic, right, in the way you talk about, what is driving inflation, why should we not care about, all that much about food and energy prices, and that could be transient, right? And when should we care about them, because we feel that they're starting to contaminate expectations.
Oh, thank you for the presentation. I think it was a very good summary of the issues surrounding monetary policy transmission. The most interesting result, I think, was where you find that financial development doesn't really matter, but and all that matters is the monetary policy framework. I wonder whether you gave financial development enough of a fighting chance. Maybe the variable you used is too broad. Maybe you could look at, is there a money market where banks can trade? Is there a yield curve that helps transmit monetary policy, not just the immediate decision, but the subsequent decisions in monetary policy, expectations of monetary policy, which it might help to have a yield
Yeah.
curve, but otherwise, wonderful paper.
Yeah, thank you. No, I agree with you. Definitely, we're always facing this problem with the data, right? So are the data really capturing the everything that we want them to, right? And of course, financial development is multidimensional, so there are many aspects to capture. I mean, we did try different variables, but I take your point, right? Those are. I think, when as a researcher, you always get very excited about your results and really want to sell them in a very strong and clear way. So it is true that financial development matters, but the point we want to make is that it seems that monetary policy frameworks matter more, right? And you can start working on that as your financial markets develop, rather than waiting for you to have a bond market before you start having an interest rate driven policy.
Thank you very much. I am Jean Joël from Côte d'Ivoire. I was wondering, for the case of monetary unions, what are the additional layers that I can say maybe conflicting interest or interest of the nations diverse in this sector to make the transmission of the monetary policy better for each country? Thank you.
Yeah, so that's a very good question. So we got into this more fundamental problem of an optimal currency area, right? So are these countries so dissimilar that it makes sense that they have a common currency, right? And I mean, recently I've been working more in the euro area, which is a currency union, right? And that has been very much debated whether they are or not an optimal currency area. I mean, if we take the argument to the limit, even large countries are not optimal currency areas, right? You can have differences in regional economy dynamics that say, well, maybe we should have 4 different monetary policies, for Northeast, North, Southwest, Southeast, and Northwest, right? But I think, I think one way to mitigate these diverging interests within the currency area members is the importance to have a truly independent central bank, right? So I think in that sense, if you look at the example of the ECB, it's a fiercely independent central bank, right? And I think in that sense, its track record has been very positive, right?
All right, great. So I think we are out of time
All right,
for the Q&A on this. So let's give our speaker another hand and
Thank you.
transition to our next speaker.